Eric Muathe at Muathe.com. Let's take a look at a continuation of this series called the Muathe Virgin Breakout. And of course, this is going to be on my YouTube channel. And here I want to just illustrate a point here because I see a nice example in the current market. And it is the chart for the dollar by way of the ETF, the UUP. What I want to discuss here is situations where the buy point is below the moving average. Here we can see that right now it seems like the 200-day moving average wants to go flat, and so what we can do here is figure out the highest daily closing high during this period, as we always do for this method. And so that could be seen as being this daily closing high here. That level so happens to be at about 24.99. Now that's why I'm saying here this is an good example that displays or shows that you can use the highest daily closing high on a daily chart whenever the moving averages are flat. Most of the time you're going to find that your buy point is going to be above the moving average. But in this particular example, as you can see, the buy point is below the moving average. So let me remove all those things. You can see here, if we assume that right now the UUP is flat here, all right, we get that off. So you can see that right now this is the highest daily closing high during the period when the moving average was flat. So this is showing you that sometimes you have to set your alert just wherever the highest daily closing high is. You can see here any movement in this chart where the stock moves above that previous daily closing high of about 24.99, which happens to be this daily closing high here. Any movement above that would trigger a move higher. Now this is confirmed by taking a look at the opposite instrument, the Euro FXE ETF, and here you can see that now this one goes inverse the dollar chart. So of course we know that UUP has a relationship, let me put it this way, has some type of a inverse relationship to FXE. So by comparing this chart, we can see confirmation that there are situations where you can use the flat pivot, or the buy point can be below your moving average. Now let me explain this. You can see here we go flat. For the most part we've been flat here on the 200-day moving average. Now this is a bearish setup because if it breaks below the recent daily closing low here, any movement below this daily closing low would suggest that it could be now setting up to drop. So of course we know that in the future, should we see a drop below that level, this daily closing low would suggest that now the moving averages are setting up to where they might eventually have a bearish crossover. This crossover could take place only and only with an acceleration of the price going lower. So that's why we use the trigger point, that if it goes below this level here and breaks below this daily closing low, the anticipation is that now it is pressed to go lower. And it does confirm our previous analysis here, where UUP has a buy point, but that buy point so happens to be slightly below the 200-day moving average. This is confirmed by the exact opposite chart, where the buy point or the sell point is below the 200-day moving average. So that confirms our theory that sometimes your buy point is going to be below the moving average. And on this chart, let me just show you a quick example here without going into too much detail, but let's just do it. You can see that there was a period sometime here in early 2016 where the 200-day moving average was flat, and during this period when the 200-day moving average was flat, the highest daily closing high was right there. So that was the highest daily closing high while the 200-day moving average was flat. And so after we see that there was an eventual breakout, that breakout above that daily closing high right here corresponds very nicely with this entry and of course we had a short-term spike. So this is what we're anticipating here. And again, that breakout was suggesting that in the future there could be a bullish crossover between the moving averages. So this is what you're anticipating, right? That this breakout here would lead to the prices moving higher. Eventually you get this crossover, which is exactly what happened down the road. Now you can see that after the breakout here, and I do digress here, after the breakout there was a slight move below our buy point. So we're talking about this period here. The stock did violate the buy point, this buy point here. It went below that. So one could say that at that point you could have been stopped out of the trade, right? And that's fine. But I want to show you that by using the other method that we use, the uniformity method, that this was not necessarily sell signal on hindsight, yes, but it is consistent with our analysis where we use the RSI to indicate or to show us where there could be a bounce. So we see that here there was a price movement where the stock made a low, RSI jumped out of this range. So we draw a line from here. We know that in the future, should we get uniform activity bounce on this line, it's a buy signal, and it is confirmed. As you can see, we bounced on the line, entry point. Again, we bounced on this line, which is this entry point we were discussing here, where it had moved below our prior buy point. So let me put that back. So this was the buy point, while the 200-day moving average was flat. That was the buy point. And of course we're talking about this period here. So we bought the breakout, or we could have bought the breakout using the Muathe Virgin Breakout method here, but there's an argument here we could have been stopped out. But what I'm saying here is, even during this drop, the stock had come back to nicely find support on this level here on the green line. We see the same type analysis here, double bottom support corresponding with that low, and recently it hit that level and is now already bouncing off that level. So what I'm trying to say, that even though this area here was violated and our breakout failed, so one, you could have been stopped out, which is okay, get a stop, or use this method here to decide that this was actually a logical re-entry level, and it was correct, because eventually the stock would move higher. As you can see, there was a move higher in the price. Subsequently, we get this crossover, which is what the Muathe Virgin Breakout is all about. You're anticipating a crossover, just like right now with a break below this recent daily closing low. If it breaks it, of course, if it breaks this level here, the anticipation is that at some point you might get a bearish crossover between the moving averages. And so the only way that can happen is with prices moving lower, and you want to take advantage of this sharp decline that eventually gives this situation where we have a crossover. So the reason for this video was to use the dollar chart to illustrate a point I tried to make on a previous video, that sometimes your buy point can be below the moving average, and that is still legit. So like in this particular example, should the dollar jump above the current recent daily closing high at 24.99, that breakout, if it takes place, is gonna be good enough, because that would suggest that what is happening is that at some point we might get a crossover between the 200-day and the 50-day moving average. It is this anticipation that we are trying to use as an excuse to own the stock, believing that with a breakout here, that eventually the prices would have to explode, because that's the only way you can get the moving averages to cross over. Eric Muathe, muathe.com. I hope that makes sense. Good luck, peace, and blessings. Mwah. E-A-C-S.